Welcome back to our weekly market breakdown. It's Monday, and the U.S. financial markets are trading with a very measured, cautious tone. We're seeing investors getting their portfolios in order ahead of what could be one of the most important weeks this quarter. Right now, the major indices like the S&P 500 and the Nasdaq are showing some modest gains. But don't let that fool you, this rally is not broad-based at all. The heavy lifting is being done almost entirely by the big names, the large-cap technology and communication services stocks. Think Apple, Microsoft, Google. Meanwhile, small-cap stocks, represented by the Russell 2000, are still struggling and under pressure. What does this tell us? It signals that investors are still clinging to quality and stability. They're not ready to dive headfirst into higher-risk assets. Instead, they prefer the perceived safety of established, profitable giants. Now, the main event, the big focus for everyone, is the peak of earnings season, which is kicking off right now. This week, we'll hear from several mega-cap titans, and their results are going to be absolutely crucial in shaping the market's momentum for the weeks to come. Investors will be dissecting every single detail. We're not just looking at top-line revenue growth anymore. We're digging deeper into profit margins. Are they expanding or shrinking? Or looking at forward guidance? What do these companies expect for the rest of the year? And we're scrutinizing their capital spending plans. Are they investing aggressively for future growth? The million-dollar question is whether this earnings strength can finally spread beyond the handful of big tech firms that have been carrying the market. If we start to see signs of broadening growth, where other sectors begin to pull their weight, then this current rally could finally find some sustainable legs to stand on.
On the macroeconomic front,
all eyes are turning to the Federal Reserve. Any policy signals or even subtle changes in the tone from Fed officials could have a massive impact on market expectations for interest rates. We've seen it time and time again. A slight shift in communication can send bond yields moving, which in turn directly affects how we value stocks. For now, Treasury yields are staying relatively stable, which suggests the bond market is in a wait-and-see mode. No one is making aggressive bets just yet. Everyone is waiting for more clarity from the Fed before making their next move. So, keep a close watch on any statements coming out of the central bank this week. Let us take a closer look at sector performance because it paints a very clear picture of what is happening. Communication services and technology are the undisputed leaders. This just reinforces the dominance of themes like artificial intelligence and the build-out of digital infrastructure. It's the same story we've been seeing for months. On the flip side, sectors like consumer discretionary, think non-essential goods and services on real estate, are showing weakness. This reflects the real-world pressure from higher financing costs and a lot of uncertainty about consumer demand. When interest rates are high, it costs more to borrow, and that hits these sectors particularly hard. Diving down to the company level, artificial intelligence remains the central investment theme. It's not going away anytime soon. Chip makers, cloud service providers, and all the companies building the infrastructure for AI continue to attract a flood of capital. This is supporting some very optimistic long-term growth expectations for these firms. Beyond AI, there's another interesting trend to watch: government-backed initiatives. We're seeing a big push to strengthen domestic supply chains, especially for strategic resources like rare earth elements. This shows how geopolitical tensions and national economic priorities are directly influencing market trends and creating new investment opportunities in very specific areas. It's a powerful reminder that politics and markets are deeply intertwined. So, to sum it all up, the current market behavior reflects a major shift towards selective participation. This is not a wild, momentum-driven free-for-all like we saw in the past. This is a market guided by hard data, by the quality of company earnings, and by the direction of monetary policy. Smart investors are focusing on positioning themselves for long-term structural trends rather than getting caught up in the short-term noise and daily volatility. If you're following the markets closely, this week is critical. The combination of mega-cap earnings reports and signals from the Federal Reserve could very well define the market's next major move. Thanks for watching. If you found this breakdown helpful, please give this video a like, subscribe to the channel, and drop a comment below with your thoughts. I'll see you in the next one.